Hello there, viewers! Today, we're diving into the thrilling world of depreciation. Don't change the channel. It's more exciting than it sounds. Depreciation is how we account for an asset's value declining over time. Think of it like that new car smell. It fades, right? That's depreciation, but for tangible assets. We're talking about buildings, equipment, computers, things businesses use to make money. Now, businesses don't just guess how much an asset depreciates each year. Nope. They use systematic methods. One of the simplest and most common, straight-line depreciation, and that's what we're breaking down today. Before we unleash the power of straight-line depreciation, let's define some key terms. Make sure to write these down. Don't worry, I promise to make it as painless as possible. First up, cost. This is what you paid for the asset. The sticker price, plus any extra costs to get it up and running. Think delivery fees, installation charges. Next, we have salvage value, also known as residual value. The asset's worth at the end of its useful life. Basically, what you think you can sell it for when you're done with it. And finally, useful life. This is the estimated time you expect to use the asset in your business. Not how long it'll physically last, but how long it'll be useful to. Got it? Good. Now, let's move on to something even more riveting. The in-service date. You might think the purchase date is the big kahuna of depreciation, but in the world of accounting, it's all about the in-service date. The in-service date is when the asset is ready to rumble, ready to be used in your business. It might be the same as the purchase date, or it might be later. Think of a fancy machine that needs to be assembled and calibrated before you can use it. Why does this matter? Because you only start depreciating an asset when it's in service, not when it's sitting in its original packaging. So remember, in-service date, mark it on your calendar, tattoo it on your accountant, whatever it takes. Coming up next, the moment you've all been waiting for, the straight-line depreciation formula. Don't miss it. All right, people, let's get down to brass tacks. The moment you've been waiting for, like Plankton has for the Krabby Patty formula. The straight-line depreciation formula. Straight-line depreciation spreads the cost of an asset evenly over its useful life. Think of it like slicing a cake into equal pieces. Here's the formula. Cost minus salvage value divided by useful life equals annual depreciation expense. Say you buy a delivery van for $30,000. It'll be useful for 5 years and then sell for $5,000. $30,000 minus $5,000 divided by 5 equals $5,000. Deduct $5,000 each year for 5 years. Buckle up, viewers, because we're about to make a journal entry. Don't panic, it's not as scary as it sounds. Every time you record depreciation, you'll make a journal entry that looks a little something like this. Debit depreciation expense. Credit, accumulated depreciation. Depreciation expense is an expense account, and we increase expenses with a debit. Accumulated depreciation, on the other hand, is a contra asset account, which reduces the value of an asset on the balance sheet. We increase contra asset accounts with a credit. So, using our previous example, each year, you debit depreciation expense for $5,000 and credit accumulated depreciation for $5,000. And that's it. You've officially mastered the journal entry for straight-line depreciation. Give yourselves a round of applause. But don't go away just yet, because I've got some bonus tips that'll make you a depreciation pro in no time. Now that you've got a handle on the basics of straight-line depreciation, let's dive into some advanced tips and resources that can elevate your depreciation game. First off, for tax purposes, many professionals refer to their state's cost index and depreciation schedule. These documents are crucial for ensuring that your calculations are both accurate and compliant with local regulations. Each state may have its own guidelines, so it's essential to stay updated with the latest information provided by your state's tax authorities. Another invaluable resource is the Modified Accelerated Cost Recovery System, or MACRS for short. This system is widely used in the United States and allows for greater depreciation expenses in the earlier years of an asset's life. By understanding and utilizing MACRS, you can maximize your tax benefits and manage your financials more effectively when filling out Form 4562. Remember, keeping up to date with the latest guidelines and schedules will ensure that your depreciation calculations are always accurate and compliant. Thank you for watching. If you found this video helpful, please like and subscribe to our channel for more informative content. Until next time, keep crunching those numbers and stay financially awesome.